Hey everybody, my name is Randy Rodenhouse, founder of the Note Authority, and today we're going to talk about buying mortgage notes and how it differs from buying real estate. But before I do, I want to give you a little overview of myself, and here's a quick bio of myself. And I started out in the corporate world. I was working for a major chemical company, a pharmaceutical company, for about 18 years as a plant manager with various positions, and had about 100 employees at the end there. And then I decided to retire and transition into real estate full time. I've been in the real estate realm for over 20 years and have been a consultant and mentor to over 300 individuals nationwide. Uh, Currently, I purchased a lot of notes in real estate recently, and in the past years, just this past 6 months, roughly $1 million worth of notes in real estate. Been involved in over 100 real estate transactions. Been a consultant, again, as I said before, to over 300 clients in the past 7 years, and have been involved in private lending as a lender and borrower, and also have been buying performing and non-performing notes for cash flow. Today we're going to talk about performing notes, but at some point in time we'll talk about non-performing as well. I've been an instructor in terms of teaching people how to invest in a self-directed IRA, and I wrote a book on it recently, and in fact that's going to be one of the bonuses for you today. I have 11 publications and 2 patents. So with that being said, let's talk about exactly what a mortgage is and a deed of trust is. I want to give you a little background because a lot of people get the terminology messed up, and I want to make sure everybody's on the same page. So what is a mortgage? Before I do so, I'm going to give you a pop quiz. And the question is a mortgage a loan? Is a mortgage a loan? And the answer to that is no. Is a mortgage a security instrument? And the answer to that is yes. And finally, do you get or give a mortgage to a lender? You get or give a mortgage to a lender. You essentially give a mortgage to a lender. You're the mortgagor, and the lender is the mortgagee. So you're actually giving the mortgage. Now, a lot of people say, oh, I got a mortgage on my house. Well, technically that's not really true the way they're stating it. They're giving a mortgage because they're basically giving their house as collateral for the note that they have. Okay, so just to be clear, a mortgage again is a security instrument that you give to a lender. The mortgage creates a lien on the property and gives the lender the right to sell the property if you do not pay on the note. So there's really 2 parties involved in a mortgage, the mortgagor, the borrower, and the mortgagee, who's the lender or the bank. So that's the mortgage in a nutshell. What about a deed of trust? Well, a deed of trust is essentially a mortgage. It's, again, a security for the note. So it's a security instrument, essentially, just like a mortgage is. However, it's a little different, and it's described here below. There are 3 parties to a deed of trust. There's a trustor, who's the borrower. There's the beneficiary, who's the lender. And then there's a trustee. And that's just a third-party person that really holds the title until the lien is paid. So the deed of trust contains a power of sale provision, and this is something that is different than in your typical mortgage, which allows the lender to sell without a judicial review. So in non-judicial foreclosure states, you sometimes have this power of sale provision. In judicial foreclosure states, you do not. The trustee, again, holds the title to the property until the lien is paid. So that's kind of the differences. Just remember, deed of trust states are like California, in those non-judicial foreclosure states. You have mortgage states like, South Carolina, Florida, and things like that. So again, this is a quick overview and gives you an idea of the terminology. And I just want to make sure everybody's on the same page because a lot of people get these things mixed up. Also note that a deed of trust is not a deed. A deed is when you transfer title from one person to another person. So again, just equate a deed of trust to a mortgage. What is a note? Again, it's pretty straightforward and pretty easy. But just to define it, this is simply a contract that details the terms of promise by one person to pay a sum of money to another person. It's simply an IOU and includes the different things like the principal amount, the interest rate, when it matures, and things like that. Like an IOU, essentially, except that the promissory note contains an affirmation to pay, And you can sell a note as long as it meets certain criteria. So again, we buy and sell notes all the time, so that's definitely allowed. So the question is, what is a performing note? Well, the definition of a performing note essentially is when someone's paying, right? But to be more exact, when you're talking about the banks and how they typically define it, they say if it's less than 90 days late, it's typically performing. So it varies from state to state, but typically less than 90 days, it's considered a performing note. So for example, if it's 30 days late, it's still considered performing. And not until 90 days do they consider it non-performing. Now again, this varies, but this just gives you a guideline, overall guideline. So how do notes compare to other asset classes? And when I say asset classes, I'm talking about other things like, comparing it to stocks and bonds, tax liens, gold, all these other type of asset classes. How does it compare to other asset classes? Well, today we're again, as we said in the beginning, we're going to compare it to real estate and see how it compares in many aspects. And you'll see that notes, there's a lot of benefits and advantages to buying notes. So again, here we're going to talk about advantages of buying notes versus the real estate itself. Well, one advantage is there's no tenants. You don't have to evict anybody, things of that sort. There's no repairs or maintenance. Remember, you don't own the property. You just own the note, and you're just stepping in the shoes of the lender. There's no dealing with contractors since you're not fixing up the house. Again, you don't own the property. You can't do that. There's no chasing of rents. You don't have to market to find deals. A lot of real estate investors do a lot of marketing to find deals, and it's pretty costly and it's pretty timely, so you don't have to do that as well. Now, again, buying real estate and doing this type of marketing is a good thing. I've done it myself and made a lot of money, and I continue to do so, but buying notes makes it much more simple. There's no homeowners associations to deal with. Where I live, there's some crazy homeowner association people that fine me for having my garage door open or leaning my bike against the side of my house. I mean, just ridiculous things like that. So you don't have to deal with all these hassles. You don't have to worry about the tax and insurance. The homeowner does. You don't have to worry about managing the property because you're not renting the property. You don't have any tenants, as I said before. It's a lot less aggravation and a lot less liability, and that's a big key. If someone buys a property and rents it, and that person trips and falls, that person can get sued. Well, as the mortgage note holder, you're not going to get sued. The owner of the property will. Less time per property. There's a lot less time per property to buy a note than there is to buy the real estate. And it's readily scalable business. I mean, buying notes, you could buy hundreds of notes, whereas you can only buy a few pieces of real estate at a time. If someone bought one property per month, that would be pretty good. That's 12 a year. Well, buying 12 notes in a week is not difficult. So you can buy, again, hundreds of notes. You can scale it, and it's much more scalable than real estate, buying the physical real estate itself. Again, it's much more liquid. If you didn't want the note anymore and you needed to raise some capital, what do? Well, you sell the note, or you sell a partial note and get some of your money back. You can do that pretty quickly. There's a lot of note buyers out there. Real estate, you have to put a sign up, you have to list it on the MLS, you have to prepare it, you have to have people walk to the property, you have to get a contract on it, and you have to get them, they have to get a loan on it and all that stuff. So again, the process is much slower. And also, it's a passive investment. I mean, buying notes and having that income come in and day out, I should say, month in and month out, it's mailbox money. And it's a great, great thing. And finally, better cash flow return. So basically, return on your investment, or the internal rate of return, IRR, internal rate of return, is much higher than on renting properties. Now, you can do pretty well and get a good return if you do things like lease options or owner finance your properties. But a typical rental, your return's going to be, 10% maybe if you're lucky. That's on a good day. And notes, you can get a lot higher return than that. So again, we'll talk about some of the specifics later on. That just gives you a good comparison. It shows you some of the great advantages of buying notes versus buying real estate itself. So with that being said, I want to give you some preview of upcoming videos. We're going to talk about factors to consider when buying a note. We're going to talk about how to evaluate a note and potential returns on those notes. We're going to talk about servicers and servicing costs. And we'll also talk about options when borrowing when the borrower stops paying. So if the borrower, stops paying on your note, what do you do? What are your options? Again, these are just some ideas that are coming down the pike, or some videos, I should say, that are coming down the pike. We're going to have a lot more, but this is what you can be looking forward to. And now I'd like to just give you the bonus. Some of you have already received your bonus, and that's why you're on this video today. But bottom line is, if you haven't, you can go to thenoteauthority.com/free gift. And once you go there, again, it's free-gift.com. I'm not .com, but it's noteauthority.com/free gift with a dash between free and gift. You go there, you're going to get three things. One, you're going to get a free book. Now, this is a PDF ebook of what's called the Stock Market Crash Guide that I wrote. It's all about self-directed IRA investing, basically buying alternative assets in your IRA tax-free. Then we're going to send you a newsletter with articles, sample deals, resources, and so forth, along with some links in there to some free videos explaining, how we buy notes, the ins and outs, I guess, the how-to of note buying. So you get some idea if this is something that you would be interested in. And we're going to show you that there's a lot of profit to be made with notes. So with that being said, I appreciate your time. And there's my contact information if you have any questions. And please feel free to email or call us. And we'll see you on the next video.